Kenya, East Africa's largest economy, started 2026 with a ratings upgrade from one of the big three firms. Moody's raised its rating from a CAA1 to B3 with a stable outlook. That makes it the most recent of the big three credit ratings agencies to revise its rating on Kenya upward. Now, alongside Fitch and S&P, all three firms have a stable outlook with respect to Kenya. A common line of argument that we're seeing among them is that they all see a much lower risk of Kenya defaulting on its external debt in the short term. When I spoke to David Rogovic, Senior Vice President at Moody's, he started our conversation by explaining the three factors that led to raising Kenya's rating and the risks that still lie ahead.
First, we saw this improvement in external liquidity, not just in the growth or accumulation of international reserves, but also a current account deficit that's been below 2% of GDP, and an exchange rate that's been stable, and it reflects an absence of any adverse or any depreciation pressure on the exchange rate. The second factor has been this improvement in financing sources that we've seen. The government's had access to the Eurobond market. This has allowed them to conduct liability management exercises where they've been buying back near-term maturities. And the last factor that supported the upgrade was this improvement in domestic financing conditions. We've seen really since the second half of 2024, domestic interest rates coming down. That's reduced the cost of government borrowing on T-bills and treasury bonds, which is the key driver of debt affordability. So in our view, these three factors all supported the upgrade. Now, this doesn't mean that there are no challenges and no credit challenges in Kenya's credit profile. The key one in our view is related to fiscal consolidation. So we have a baseline scenario where the government's fiscal deficit remains close to 6% of GDP. That stabilizes debt, but that's in the absence of any adverse exchange rate pressure. That's under the baseline assumption where domestic borrowing costs come down and where the government maintains and remains, has access to various sources of external funding that don't put pressure on debt affordability or on the interest burden.
One of the things that you pointed out in the rating is that you're not expecting the reserve position to rise materially beyond current levels at about $12.3 billion, I believe, as of the end of last week. Is that being driven more by the fact that the current account deficit is widening gradually? We've seen that happening over in 2025. It likely will continue this year. Or is that more because of a change in policy by the central bank? Because they've been very focused on accumulating as much dollars as they can to get reserves to where they are now.
Yeah, so it's not driven by a change in policy per se. I think it's just when we look at the overall factors driving reserve accumulation, and we look at the amount of external amortizations, that we think the current account at this level is sort of balanced or in an equilibrium state, so to speak. And in these conditions where you do have some improvement in domestic demand and pick up in investment, construction activity, that will lead to a slight increase in imports. And again, at this current level of the exchange rate, we don't see material pressure for it to weaken. We think at this level, we also don't see additional pressure for it to strengthen further. And so over the course of the year, then there will be some ups and downs. But over the course of the year, we would expect reserves to remain around current levels, notwithstanding there's also the Safaricom privatization that will lead to some inflows. But when we look going forward, we don't see the pressure for reserves to continue to accumulate. And admittedly, they are at a healthy point right now, over 5 months of import coverage. So when we look at the amount of reserve coverage relative to the amount of debt coming due, relative to the amount of imports or any other measure of external vulnerability, you would say that the level of reserves today is healthy and at a stable level.
One of the ways in which Kenyan authorities have been tapping into external sources of funding is through securitizing domestic flows. So we've seen that with the road maintenance levy, which has been securitized, some of the proceeds being used to pay contractors. The railway development levy is also being utilized, or rather securitized, to pay for the extension of the rail line all the way through to the Ugandan border. And one of the things that you flag in this report is that, the Kenyan government has a combination of weak institutions and weak policy predictability. So this securitization process, does it constitute a material risk to Kenya's debt affordability metrics?
Well, the first thing I would say about the securitizations is that it's something that we do see other governments utilize. We've seen countries in the single B rating space utilize securitizations of airport revenues, other revenue streams. So it's not uncommon, let's say, at first. The key issue, in our view, from the securitizations of these levies is that it further narrows the revenue base and the size of the revenue pool the government has to service its existing debt. And you mentioned debt affordability here. Kenya's debt affordability, the way that we measure this is through interest as a share of revenue, is approximately 33%. So about 1/3 of revenue is going to service just interest, not to speak of debt, of servicing maturing debt. So 1/3 of your revenue goes to service interest, and then you're now reducing that revenue pool. And if the fiscal deficit doesn't narrow, then you have spending pressure that you need to finance. And if it's not through revenue, then it's through borrowing. So the key issue really is that it's already weakening or narrowing an already narrow revenue base, which has, over the past decade, for example, has declined steadily. So it's adding to the pressure that we're seeing there. But again, in our current base case scenario, we don't see debt affordability worsening further from here, but that's dependent on interest rates coming down and the sources of external financing being such that they don't add pressure to the interest bill.